Hello, welcome to another video of Engineering Economics INEN 2373. In this video we're going to work with financial ratios. Remember to read about financial ratios on your textbook on section 16.4.3 on page 798 and the next few pages. So the few financial ratios we're going to discuss are here described in the bottom right hand side, and the first one is the return on assets. The return on assets is computed as the net income divided by the average total assets, and in this example the values are 51,973 divided by the average of the total assets over the last 2 years. That's the average between 580,000 and 650,000 for a number of 8.45%, and that's how much out of all the assets that we are employing, how much benefit we are obtaining from them. The next financial indicator is the return on owner's equity. The way to compute that is the net income divided by the average owner's equity. This is 51,973 divided by the average of 228,427 and 240,400. The ratio that we get is therefore 22.17%, and that is how much a percentage of the benefit that we get out of the total investment that the owners have in the corporation. And this is one of the three areas that ratio analysis focus on. It's the earning power. These two measures are about earning power. The next one is the current ratio, which is the ratio of current assets divided by current liabilities. This result is 344,500 divided by 309,600, and the number is larger than 1.112, which means that we are able to cover our short-term liabilities with the current cash, with the current assets that we have. A more stringent measure of short-term liabilities is the acid test ratio. In this example, we are adding cash and accounts receivable and short-term investment. We are not taking into consideration inventory, and we divide that by current liabilities. Again, ideally the number should be larger than 1, but in this example we add 61,750 plus 195,000 divided by 309,600 with a result of a 0.829, which is less than 1, which is not ideal. The next one is the accounts receivable turnover. The accounts receivable turnover is computed as the net sales divided by the average accounts receivable, and the numbers are 1,625,450 in sales divided by the average of accounts receivable 130,500 and 195,000. The total number is 9.98, and the interpretation of this number is that we are able to collect about 10 times our sales during the year. The next financial ratio is inventory turnover, which is computed as the cost of the goods sold divided by the average inventory. And the numbers that are presented in this case is 1,287,103 divided by the average of 50,000 plus and 65,000. The ratio is then 22.38, and the interpretation of this number is that we are able to rotate our inventory or renew our complete inventory about 22 times in the year. In the long-term ratio, we have the debt to equity ratio, that is total liabilities divided by the total capital worth. The numbers are 409,600 divided by 240,400, and the number is 1.7, and that looks well, this is the only indicator that the higher is not necessarily the better. All others, the higher the better, not necessarily in this one. Then we have times earned times interest earned ratio. It's the net income before taxes and interest divided by the interest charges, and that means our capacity to pay the interest on the debt that we have. The numbers are 113,761 divided by 21,600. The number is 5.27, and since it's just larger than 1, we can pay our debt with no problem, at least the interest on the debt. And then the final one is the operating income to total assets ratio. That is 113,761 divided by 656,000. That's the net operating income divided by total assets, and this is 17.50, and it's a measure of the performance of the company in terms of the operation. In order for you to see a further explanation on this, again, please take a look at the sections in the book.